He's joining us now by phone for a look at the fixed income market is Greg Davis, Chief Investment Officer at Vanguard. Greg, thanks for joining us today. And this would be really invaluable to a lot of our viewers that have watched equities, have been in probably Vanguard equity funds, et cetera. But certainly would be nice to lessen the volatility and the risk in portfolios at this point. How can they do that?
Well, Joe, thanks for having me on this morning. It's one of those things where we've always tried to encourage clients to make sure they maintain a highly diversified and balanced portfolio across equities, bonds, cash, and ultimately trying to focus on controlling what they can control, and that's ultimately cost. We never know exactly what's going to happen with the markets longer term, but if you have a highly diversified portfolio across those three sectors, you can weather any significant market volatility, and we've seen a lot of our investors do just that during this pandemic.
What can be done to just enhance yield and not really give away any of the lower volatility or the lower beta that fixed income provides?
Well, you've seen in our active fixed income process, we've been focused primarily on taking advantage of some of the dislocations that happened in the investment grade market as well as high yield. We saw spreads widen pretty dramatically when it comes to emerging markets, but there were also some unique opportunities even within mortgages, within the tip sector. As those became unbelievably cheap from our perspective, we had an opportunity to add some risk in that portion of the market, and so we've created a highly diversified portfolio that because we were conservatively positioned coming into this pandemic, we've been able to add risk along the way to help boost returns.
Have there been any instances where you heard something, the new initiatives from the Fed, and where you just said, "Whoa, wait a minute, read that again," and does it affect how you're managing things? I mean, this is pretty This has been shock and awe with some of the moves. Any of them really surprise you and change your outlook or what you should be doing?
I mean, we've been really impressed by the activity from the Federal Reserve as well as the fiscal response that we've seen out of D.C. in terms of trying to mitigate some of the economic challenges that are coming out of this pandemic. I mean, what I would say is if you go back to March and take a look at how dislocated portions of the markets were becoming, the Fed stepping in, buying large amounts of treasuries, buying large amounts of mortgages, coming out with the money market liquidity facility, which was a big improvement to market functioning. You couple that with the secondary market corporate credit facility, those were all things that helped stabilize the market and actually saw us, have a pretty significant rebound across all risk assets from that point forward. So, we think the Fed has done a tremendous job helping stabilize and provide liquidity in the marketplace, and that's why we've seen a pretty significant boost in risk assets from that point forward.
Well, Greg, I guess I was kind of asking about, and we haven't heard the term, and I always kid Becky about it, but the vigilantes. If you were to tell someone where the Fed's balance sheet would be and where the fiscal balance sheet, what that would look like in terms of deficits, I don't know if this is what you would expect in terms of the yield and the yield curve. Won't there be a day of reckoning if interest rates go up and we've got all this floating that it's going to be a problem?
Well, I think longer term, first thing you have to keep in mind, Joe, is look, you have an environment where we're in a crisis situation, so you want to make sure that you throw everything that you can at it to try to get us out of this significant downturn from an economic standpoint, this health crisis that we're facing. And the Fed and the fiscal authorities have really done that. Longer term, clearly there's going to be some reckoning that has to happen in terms of the amount of debt that's outstanding and the impact that's going to have on interest rates. But, if you look at other markets outside of the U.S., you look at Japan where, they have a debt to GDP ratio over 200%. We're a long ways away from a place like Japan, so there's probably still significant room within the U.S. for us to, expand the balance sheet. But it is a risk factor that the Federal Reserve, the Treasury, and, investors need to keep in mind longer term. But right now, the focus should be on stabilizing the economy and getting people back to work.
I guess we're starting to see some glimmers, and people pointed out yesterday that yields backed up a little in spite of some of this China rhetoric heating up. Is global growth, are we on the other side of the concerns there from the pandemic? at this point? And are we never going negative here like some of the rest of the world? Can we take that off the table for the United States, Greg?
Those are really interesting questions, Joe. I mean, when we think about the the economic side of the equation first, we would say that, look, things are probably still going to get worse before they get better. We are expecting that the second half of this year we'll start to see improvement. A big part of that is assuming that we are going to get closer to seeing a vaccine being developed, with probably some more details coming out as we go to the later end of this year and beginning part of next year, which should provide some positive momentum from an economic standpoint. In terms of your question around negative interest rates, the Federal Reserve has come out multiple times and indicated they have no desire to go negative. They have a number of other policy tools that they could use to continue to try to help boost economic activity. And the question becomes, ultimately, have negative interest rates actually been effective in places like Europe or Japan? And we have a big difference with the U.S. market is that we have a much larger money market, industry in the United States relative to those other countries. So the impact that it would have on money market funds in the U.S., the banking industry, I think is something that the Federal Reserve is keeping top of mind.
I mean, I can't believe you got an 8% one-year return on the Vanguard core bond fund. Anyone would want that, especially with the lower volatility. If we did have a big backup in rates, would you be able to handle that if it ever comes when we're least expecting it, or could you actively manage it to not lose principal on some of the long stuff?
Well, I think the way you have to think about it is there's always going to be that interest rate sensitivity in a fund like that. Where we try to typically add value is around the corporate positioning, the weighting that we have in emerging markets, trying to be thoughtful in terms of the types of mortgages, the specific pools that we invest in, and trying to add value more from a security selection standpoint. But overall, you're going to have that interest rate exposure that if you do get a big backup in yield, you do run the risk of some price deterioration.